This is where I'll start recording, and then I will add this piece to the YouTube channel later tonight once it processes. This is a very powerful looking chart here in the Dow. Compared to the S&P, this little one-day pullback was much less significant. It has been riding the upper edge of the river on a daily basis, made a new high on Thursday. This congestion or support level here, this consolidation pattern, never really threatened to even get back to the Bollinger Band mean. The 30 periods regression line slope is favorable. That's just a straight line up in the flow of the river. I mean, it doesn't get any smoother and upward than that. It's leaving the 200 behind. So that's really a favorable chart. If you compare that to emerging markets, however, you can see that's almost the opposite story. They had their good long run up here to this peak around 45 and has been declining with increasing sizes of pullbacks and then resulting gains, but each subsequent high was lower than the previous one. This last one got to the bottom of the floodplain, has now just re-entered the river. The good news is that there's now a measured target up here at around 45 that offers about an 8% recovery target, and 3 very strong days last week. So that may be enough of a pullback to signal a change in the EEM, but to me the default position is the EEM would have to prove that it's going up faster than the market next week to start getting some of the money back. On an intraday basis, it certainly can be traded. EFA is about halfway between the emerging markets and the diamonds, for example. You can see that its upward move has intersected the price ribbon now, whereas in the Dow we never even saw that happen. In the Dow, that big one-day pullback here on February 25th actually came down and tested and left the floodplain, whereas in the Dow it didn't even get, or it just barely got to the Bollinger Band mean. So on a relative strength basis, the U.S. has been more robust to these kinds of system shocks. And then whereas the Dow was flat over the last 10 days, there's actually been a measured pullback here in EFA. But this is what makes a 551 pattern. Compared to 5 weeks ago, price is higher than it was 5 weeks ago, but it's down compared to the price 5 days ago, so that's the 5 and the 5. And then 1 day of positive momentum, that's the 1, and then there's a 2-to-1 reward-to-risk ratio compared to a test of the 10-day high. So this is a perfect example of a 551 pattern. So the 5-week move is up. Let me try to do that with a pen, sorry. So the 5-week move is up. The 5-day move is down. There was 1 day of positive momentum, and then on a trade location basis, there's a 2-to-1 reward-to-risk ratio, and that's what makes that a 5-5-1W pattern in EFA. You should be able to spot those kinds of opportunities from a distance. Let's take a look at Japan. Has been just exceptionally strong on the ETF2 and then on the blended monthly rebalancing, and you can see why here. This has really kind of been a stealth move in Japan, but the numbers don't lie. It's just straight up. You don't even see that same pullback from March 25th. Again, that didn't even make a new low. It didn't even get to the Bollinger Band mean, and the last 10 days have actually been up as opposed to a consolidation pattern we saw in the Dow and then the negative response in EFA and then EEM. So in terms of relative strength, Japan continues to be very strong. Okay, let's see if we can shift over to the individual stocks now in our time remaining. Excuse me. So we'll start with Alcoa, and this is the worst performer in the Dow, and you can see why. It's under the 200 period moving average. The river has rolled over, and the river has actually entered the lava, if you will. The river is going underground. That's a bad sign. Two days of support, that's true. So if we hypothesize this as a triple bottom of 1, 2, and 3, and then 2 days of momentum, 10-day high, it's still hard to see a 2-to-1 reward to risk in there. There's not much gain. It really would have to get through a lot of this resistance here at the 200 moving average, and then and only then could we think about it getting back to this double top. That looks like two sets of channels in here. This channel where it's right in the middle, and that just doesn't test out very well. And then this channel. If it gets above 860, then there's room for a 2-to-1 test of the next swing high. But inside this channel right now, there's so much resistance at 870 that even if you try trading this one, you'd have to be very, very quick on the trigger to exit once it starts stalling. So I don't see that one as an easy trade. You got to be an Alcoa trader to play that one. And the reason that you would probably prefer not to trade Alcoa is why would you necessarily go after that when you have this one, AXP, which we saw was one of the rising stars in finance, American Express, which is doing nothing but going straight up. And if you take a look at what it did on that February 25th pullback, didn't even register, and established a nice base, and then a nice breakout, another short base, just 4 or 5 days, and has been really moving up, and no resistance overhead, and increasing separation from the 200. So you got to like all this. AXP is where you want to be. And compare that to one of the financials that has begun to fallen out of favor. So if you're going to be in the financial arena and you saw XLF was going up and Travelers was doing better than Bank of America, it wouldn't surprise you because Bank of America is going down while American Express is going up. On the other hand, if we say that this is support, a big support level, it wouldn't surprise us to see it find support at the Bollinger Band mean, and then you could buy Bank of America on sale. But at the same time, American Express has new money, fresh blood, and that's a favorable kind of a target. There's no reason to disbelieve American Express. You can see the problems in Caterpillar here. After a retest of 99 or 100, it's just failed back to the 200. So it's all of the gains up in here have been sacrificed in this painful move down. However, it has put in a little base, a base of support here at 86, where it found support the last time. And so with a nice little doji in here, we do have some tactical trading possibilities looking at 91, 93, 95 as potential targets. So tradable, but on a tactical basis only. You can actually see how the slope of the regression line has been improving as it has not failed as much. Now, just because the slope is improving, it's still below the dotted line, so the slope is still negative, but the rate of decline, when it curls up like that, what that's saying is the rate of decline, the rate of failure is slowing down considerably. So we may be at this may be the first half of the next cup and handle. You know, so I'm fully prepared to be trading Caterpillar in its upward move should that happen. What I like about buying deep value and buying after the pain is that I can observe in the recent past levels of support and resistance that if price gets to there and then starts behaving, I can interpret that in a way as to say, is that upward trend continuing, or is it likely to, and if it starts failing here, then I know where it's easy for me to believe in that and then go ahead and get out. So it makes it very easy to pull the trigger to preserve profits. Cisco is a tech name that offers an opportunity here. There was a big gap down that has sort of resolved itself around 2075 at the last support level. So this is one that can go in either direction. If it fails out of this little consolidation zone, you can see that it gets to 19.5 pretty quickly. And then if that's the case, this would be Cisco rolling over. But if it breaks out of this move and goes up, 22 is in sight, and the move from 21 to 22 is a 5% move in a short period of time. It could make that move in as little as 2 days. So that's nothing to sniff at. You can see that Cisco, when it moves up, tends to be very trendy on its short-term swings. But this is one that you would, at the most, you'd be looking at holding 2 or 3 days at a time, because it doesn't put in those kind of long extended runs like we saw in AXP. This tends to go in short fits and starts. Let's see, DuPont was a, oh man, is that sweet. I love this one in DuPont. So we have the river. Everything about this river looks good to me. It's coming out of the 200. The river is coming out of the sea, you know, and it's had a really nice run up. That's a value play, and we've seen it marching up the quality chart and the blended monthly rebalancing chart. And we've had that first nice move up, a very orderly pullback after a nice trend, and now 551W. That is just as nice as it can be. And it's still early in the life cycle of the return to glory of DuPont. So I think that's just a fantastic looking chart. It's still early, but you have a lot of evidence that suggests there's believers in it. And the fact that it's still so close to its 200 means that you're still relatively early. This is about a third mouse or maybe fourth mouse buy here, but still I really like that pattern. This is nice in Disney. This was another one of those emerging value leaders from the quality report. Everything's good about the river. It's held support at the Bollinger Band mean, just like it's supposed to, for 10 days of consolidation, and had a nice 2-day closing session here. And once it gets through this 58 or 57.5, it's all systems go, and then everybody will say, well, obviously that's an easy trade. But everything looks good here, and you can buy Disney on sale. Home Depot was another stealth, as I recall. And again, a nice consolidation pattern here above the Bollinger Band mean. Nice finish on Thursday. Again, it's got to get above 71. Once it does, that's going to go. I would, if I saw a big white candle that was going to test that again, I'd like to buy that one on a swing basis, believing that momentum will carry it through 71, and then that's the last resistance above, and then it has a nice another leg up like this potentially if it can get through 71. So Home Depot is definitely a definite possibility. Hewlett-Packard, just nothing but greatness. If you recall, this is like that DuPont chart, except it doesn't even have any kind of pullback. This is just going to go up and up and up. The best performer in the Dow is doing better than 1,400 different ETFs. And the beauty of this thing is it's just now creating this zone of separation from the 200 period moving average. I mean, the 200 period moving average is still facing down. This thing is still early in its potential gains. Maybe this is the next Apple. Who knows? Johnson & Johnson. This is the strength behind that move in XLP. XLP has doubled the performance of the S&P. It's because of this. I mean, when you look at these charts week over week, you just say to yourself, well, just damn buy it. You know, put a stop in down here. Buy any day you want with a stop below the 30-period moving average, below the Bollinger Band mean, and just let it go. Johnson & Johnson, that's XLP. I mean, sometimes that's all you got to do. J.P. Morgan, this is the last one we'll look at. This is what more like the end of that trend looks like. So that powerful move up and then a measured pullback to the bottom of the floodplain. And this is still an outperformer compared to the rest of the Dow over the last 6 and 12 months. So big move up, measured pullback to the resistance or the support level at the bottom of the river, and continuation. Even if you're just looking at a return to 51, that's an 8% move or 7% move. And then if it gets through 51, it'll be the return of J.P. Morgan to greatness. So, you know, from a style perspective, that's where you should compare that to American Express and Travelers and Johnson & Johnson. Say which one do you really need to see this as so that you're buying value, or can you just go ahead and buy Johnson & Johnson because it's going up? Let me see if we can find travel. Oh, that was good in Coca-Cola. They come here. No, McDonald's. I like this in McDonald's. It responded to strength pretty well on Thursday and Friday. A nice consolidation zone in here, and off it's going to go. You know, these little moves, when the slope is up and it finds support at or above the Bollinger Band mean and starts taking off, I don't even wait for it to make a new high. I buy the resumption of the move up and believe that it's going to go through that and carry me through. I don't want to wait for the breakout to occur and then chase. I would rather be positioned just prior to breaking through and then get carried up by that sudden surge. That's true for intraday as well as on a swing basis. All right, so that's everything I wanted to talk about. We're 55 minutes into it, so I'll post this video at the YouTube channel if you want to study some of these swing charts a little more. But I definitely think there's some real good possibilities inside the U.S. right now in the large caps, especially in the XLP and XLF sectors and some of the leading candidates inside those sectors. So I'll leave it open for a few minutes for your questions, but otherwise I wish you a happy Easter, what's left of it. And the soccer teams did really well this week. We had 3 victories between the 2 teams, and then we had a little team function down at Sporting Kansas City, our professional team. They turned in an impressive victory over Montreal. So it was a real good soccer weekend for us. So if there's no questions, doesn't seem to be any. So I'll bid you all good night and see you in the chat room.